Imagine opening a mortgage quote and seeing the payment move higher before you even choose the house. Nothing dramatic happens in the room, no siren, no crash. Just one number changing, and suddenly the future feels more expensive. That is why markets read Fed minutes like a warning label. The Federal Reserve released minutes from its April meeting. The message was not simple comfort. Officials were watching inflation risk closely, especially if oil and war pressure kept prices high. Inflation means everyday prices rise. Interest rates are one tool the Fed uses to slow that pressure. But when rates rise, borrowing gets heavier for families, businesses, and markets. Think of interest rates like gravity. When gravity is light, people can carry more: house loans, business plans, stock valuations, and big dreams. When gravity gets stronger, everything feels harder to lift. That is what shocked markets in 1994. The Fed raised rates faster than many investors expected. Bonds fell. A bond is basically an IOU. When rates jump, older IOUs can lose value because newer ones pay more. Today is not 1994, but the fear is familiar. What happens if markets are priced for calm and the Fed sounds less calm than expected? The turn comes when investors stop asking, when do rate cuts start? They start asking, could rates go higher instead? That one question changes the room. Stock prices, bond prices, mortgage quotes, credit cards, and business loans all start listening to the same signal. In 1994, the pain hit bond funds, lenders, and companies that were built around easier money. Today, the pressure would travel through a different economy, but the human effect is easy to see: higher payments, delayed purchases, tighter business plans, and less room for mistakes. Different decade, same gravity. The lesson is simple. Fed minutes are not just paperwork. Sometimes they are the sound of gravity changing. What rate would make you pause?